We often picture retirement as a calm harbor, a place of earned peace and security. Years of diligent saving are meant to culminate in steady income, with worries fading like distant echoes. Yet, what if the very vessels we've entrusted with our financial future, these safe retirement funds, are silently drifting towards a hidden reef, a ticking time bomb beneath the calm surface? Perhaps a quiet unease has already settled within you, a whisper of doubt amidst the reassuring narratives. For those who have navigated deep personal losses, the sudden void of absence, the sting of institutional betrayal, the profound feeling of invisibility, this financial uncertainty can feel like another weight upon an already burdened spirit. The struggle to translate complex financial theories into actionable strategies, the overwhelming noise of conflicting market information, the fear of making a costly mistake. These are not merely intellectual puzzles. They are deeply felt anxieties that demand a gentle yet unflinching examination. Consider this unsettling truth. A significant portion of average retirement plans, often deemed safe, struggle to genuinely keep pace with the relentless erosion of inflation or withstand the sharp downturns of unpredictable markets. This isn't just about minor fluctuations. It's a systemic vulnerability, a quiet erosion that many conventional approaches fail to address. We are here to uncover these hidden risks, those subtle yet powerful forces that can transform a seemingly stable fund into a source of profound future anxiety. Benjamin Graham, the quiet architect of value investing, offered a profound compass. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. This wisdom calls us to look beyond labels, beyond marketing, and to truly analyze. It asks us to understand the underlying mechanisms, not just the perceived outward stability. Is your diversified portfolio truly diversified, or is it a collection of similar seeds planted in the same vulnerable soil, susceptible to the same unseen blights? Our journey today is one of demystification. We seek to equip ourselves with the knowledge to discern genuine safety from mere appearance. We will walk through the deceptive nature of inflation, the unseen claws of market correlation, and the behavioral traps that often cloud our judgment. For in understanding these hidden truths, we begin to forge a path toward truly sustainable wealth creation, a path where our financial independence is built on the bedrock of data-driven truth, not on the shifting sands of conventional assumption. Don't just invest, understand the why behind every decision. Imagine inflation not as a sudden, violent storm, but as a persistent, unseen mist that slowly, inexorably erodes the very bedrock of your savings. This silent thief works relentlessly, diminishing the purchasing power of every dollar you've carefully accumulated for your retirement. For those who have poured years of their life force into building a secure future, only to feel its value quietly slipping away, it can feel like a profound betrayal, a silent mockery of diligence. Historically, even a modest 3% annual inflation rate can have the purchasing power of your money in just 24 years. Consider a seemingly robust $1 million retirement fund today. If inflation continues its quiet work, that same $1 million 2 decades from now might only command the buying power of $550,000 or even less, depending on the economic winds. This isn't a hypothetical fear, it's a historical reality that has left countless individuals facing a future far less comfortable than they had meticulously planned. The comfort of safety in fixed income investments, like many traditional bonds, can be a mirage. While the nominal principal might remain, its real-world value, its ability to provide for your needs, diminishes with each passing year. The myth that safe investments inherently protect against inflation is one we must challenge. While they might preserve your initial capital in dollars, they often fail to preserve its value. What then can we do? We must look beyond the obvious and seek assets that breathe with the changing winds of the economy. This means exploring investments that have historically demonstrated their ability to outpace inflation, such as certain real estate holdings, select commodities, or inflation-protected securities. It demands a deliberate shift in strategy, moving from passive acceptance to informed, proactive decision-making. To truly safeguard your future, you cannot afford to rely solely on traditional retirement plans that overlook inflation's long-term effects. This vigilance is not about chasing fleeting gains, but about preserving the dignity and security you have earned. Are we simply accumulating numbers, or are we building a fortress of enduring value against the silent erosion of time and price? What steps will you take to ensure your hard-earned wealth doesn't become a casualty of this unseen force, the very ground beneath our feet? Even in what seems like the most conservative of investment landscapes can shift without warning. We often place our trust in safe retirement funds, believing they are immune to the market's deeper currents. Yet, history whispers a different tale, a sobering narrative of market crashs and corrections that have tested even the most steadfast portfolios. The calm surface can be deceptive. Beneath it, unseen forces are always at play, capable of delivering an unexpected blow blow that can leave one feeling exposed and vulnerable. Perhaps one of the most insidious threats is what is known as sequence of returns risk. Imagine you are just about to harvest the fruits of your labor, nearing retirement, when the market takes a significant downturn. The timing of these negative returns, especially early in your withdrawal phase, can devastate a portfolio, even if the market later recovers. It's like trying to draw water from a well that's suddenly running dry at the precise moment you need it most. Even if the rains eventually come, the immediate thirst can be overwhelming. This isn't about predicting the next storm, a futile exercise that even the most seasoned investors have failed at consistently. The illusion of perfectly timing market entry and exit often leads to more heartache than triumph. Instead, wisdom lies in understanding the inherent unpredictability and establishing a robust framework that can weather these inevitable storms. This means cultivating a true diversification across different asset classes, not just different stocks, ensuring your diversified portfolio isn't actually concentrated in similar risks. It involves a thoughtful, tactical asset allocation, adjusting your sails not to chase every gust, but to navigate the prevailing winds. Above all, it demands the unwavering gaze of a long-term horizon, recognizing that true wealth is built through patience and resilience, not reactive panic. Warren Buffett often speaks of the importance of having an emotional temperament that can handle market fluctuations. It is about understanding your own risk tolerance, the emotional capacity to absorb temporary setbacks without abandoning your core principles. For when the market roars and the headlines scream, it is our inner resolve coupled with a well-defined strategy that truly protects us. How deeply have you truly understood your own capacity for risk, and what is your plan to hold steady when the inevitable market waves crash upon the shore? Challenge the consensus. Find your edge. Within the seemingly calm waters of our retirement funds, there often lurk unseen currents, subtle drains that can quietly yet powerfully diminish our future security. These are the hidden fees and expenses, often overlooked yet relentlessly at work. Management fees, expense ratios, transaction costs. These are not just abstract numbers. They are real dollars, slowly siphoned from the wealth you have painstakingly built. For those who feel the burden of every hard-earned dollar, this silent erosion can feel like a profound injustice, a hidden tax on diligence. Consider this: a seemingly modest 1% annual fee on a retirement fund might appear insignificant. Yet, over 30 years, that seemingly small percentage can devour a staggering 28% of your total returns. On $1 million portfolio, that's nearly $280,000 lost, not to market downturns, but to silent, persistent charges. It's like a slow leak in a vessel you believe to be watertight, draining your precious cargo drop by precious drop. This compounding effect of fees is a powerful, yet often underestimated, force working against your wealth accumulation. It reveals a stark truth: the difference between a high-fee fund and a low-cost alternative can equate to hundreds of thousands of dollars over a lifetime. When we compare different types of retirement funds, the impact of these fee structures becomes strikingly clear. Funds with higher expense ratios consistently underperform their lower-cost counterparts over the long term, even before considering any difference in investment strategy. This isn't about chasing fleeting trends. It's about making a fundamental choice that respects the power of compounding either for you or against you. What, then, is our recourse against this silent drain? The path forward is one of deliberate inquiry and informed selection. Actively seek out low-cost index funds or exchange-traded funds, which are designed to track market performance rather than actively manage portfolios at a higher cost. More importantly, cultivate the discipline to meticulously review fund prospectuses, looking beyond the marketing and into the cold, hard numbers of expense ratios and other charges. This isn't just about saving money, it's about reclaiming your financial sovereignty. Before committing your precious capital, actively research and compare the fees and expenses of every investment option. Is your vigilance sharp enough to detect these subtle drains, or are you allowing your future to be quietly diminished by what you don't see? We're uncovering the hidden truths behind wealth accumulation. Life, in its profound unpredictability, often presents us with unexpected turns, moments that can disrupt even the most meticulously planned financial futures. We pour our energy into building retirement savings, envisioning a predictable path, only to find that unforeseen expenses, a sudden medical emergency, the soaring costs of long-term care, or a catastrophic home repair can emerge like rogue waves, threatening to capsize our carefully constructed plans. For those who have known the pain of sudden loss or the quiet despair of unforeseen burdens, the thought of these financial shocks can compound an already tender heart. We hear stories, perhaps even live them, of individuals whose retirement dreams were shattered not by market crash, but by the relentless drain of medical bills or the staggering cost of care in later years. A lifetime of savings, accumulated with such dedication, can vanish in a few short years under the weight of these unexpected burdens. It's a stark reminder that true financial security extends beyond investment retirement returns. It encompasses a preparedness for life's inevitable uncertainties. This is why the presence of a robust emergency fund is not merely a suggestion. It is a vital lifeline, a sanctuary for your peace of mind. Beyond that, a well-thought-out contingency plan becomes your unwavering anchor. It's about building a financial moat strong enough to withstand unexpected shocks without forcing you to liquidate your long-term investments at an opportune moment. To truly fortify your retirement, we must engage in a sober, data-driven assessment of potential future expenses. This involves not just acknowledging, but actively planning for possibilities like long-term care, perhaps through dedicated insurance or a specific allocation of assets. It's about envisioning potential challenges and proactively creating solutions. Ray Dalio, with his emphasis on understanding risk, would remind us that anticipating and preparing for the unthinkable is often the most intelligent form of defense. Your retirement plan, therefore, is not a static document. It is a living, breathing strategy that demands regular review and adjustment. Are you actively preparing for the unexpected, or are you leaving your future vulnerable to the caprices of life? Don't just invest. Understand the why behind every decision. We have journeyed through the unseen currents that threaten our financial peace. Inflation's silent theft, market volatility's unexpected blow, the persistent drain of hidden fees, and the potential devastation of unforeseen expenses. Each of these can feel like a separate challenge, but together they form a complex web capable of turning a seemingly safe retirement fund into a ticking time bomb. For those who have felt the weight of financial uncertainty, understanding these forces is not about fear, but about reclaiming a sense of agency, a quiet strength in a turbulent world. To build a truly resilient retirement, we must move beyond conventional assumptions and embrace a strategy that anticipates and adapts. This means cultivating a diversified investment approach that thoughtfully combines growth-oriented assets, those that have the potential to outpace inflation over the long term, with income-generating assets that provide a steady stream of cash flow, offering a degree of stability even when markets are unsettled. It's like building a ship designed not just for calm seas, but equipped to navigate both the powerful winds of expansion and the deep troughs of contraction. A crucial, often overlooked discipline in this journey is regular portfolio rebalancing. This isn't about chasing market fads. It's about gently, consistently bringing your asset allocation back into alignment with your desired risk profile. When one part of your portfolio grows disproportionately, rebalancing means trimming those gains to reinvest in areas that may have lagged, maintaining balance and managing risk with serene intention. This systematic approach, advocated by figures like Ray Dalio in his all-weather strategy, fosters a long-term perspective, preventing emotional decisions from derailing your carefully laid plans. The path to a secure and sustainable retirement demands proactive engagement and informed decision-making. It begins with developing a comprehensive financial plan, a living document that reflects your deepest values and aspirations, not just your assets. Seek wisdom, not just advice. Find mentors who speak with data-driven truth and ethical clarity. And most importantly, commit to staying informed, to peeling back the layers of market noise to discern the genuine underlying mechanisms. This isn't just about managing money, it's about nurturing your future with intention. Are you ready to actively sculpt a retirement that is not merely safe, but truly resilient, a testament to your unwavering insight and resolve? Challenge the consensus. Find your edge. We have journeyed through the subtle currents that threaten the calm harbor of our retirement dreams: inflation's silent, persistent theft, the market's unpredictable, often jarring volatility, the quiet yet powerful drain of hidden fees, and the unforeseen expenses that can emerge like sudden squalls. Each of these forces, left unaddressed, can indeed transform a seemingly safe retirement fund into a silent ticking time bomb, slowly eroding the peace and security we envision. For those who have felt the deep ache of vulnerability, understanding these mechanisms is the first step towards true empowerment, a reclamation of control over one's own destiny. The path forward is one of informed vigilance and deliberate action. It means moving beyond passive acceptance to actively sculpt a future that can withstand these challenges. Diversifying your investments not just across different companies, but across genuinely different asset classes builds resilience. Minimizing fees by scrutinizing every prospectus and choosing low-cost alternatives ensures more of your hard-earned wealth compounds for *U**. And planning for the unforeseen, establishing robust emergency funds and considering safeguards like long-term care provides a foundational piece that no market fluctuation can entirely disturb. Warren Buffett, with his deep wisdom, reminds us that someone is sitting in the shade today because someone planted a tree a long time ago. This isn't just about planting, it's about nurturing the tree with discernment, protecting it from unseen blights, and understanding the soil it grows in. It speaks to the profound importance of long-term vision and disciplined financial planning, a continuous act of tending to your future with intention. As we conclude this reflection, reflection, I invite you to a moment of quiet introspection. Take a breath and truly feel the weight of your financial hopes and anxieties. Imagine holding your retirement plan not as a rigid document, but as a living seed in your hand. What nourishment does it truly need? What hidden threats might still lurk beneath its surface? Is your retirement plan merely a collection of assumptions, or a meticulously cultivated garden, resiliently designed to flourish through all seasons? What single, data-driven truth will you seek out this week to fortify your understanding and reclaim your financial sovereignty?